Welcome to Mastering Your Financial Life, hosted by Judy Heft, the founder and CEO of Judy Heft and Associates, Financial and Lifestyle Concierge. This year, she's celebrating 27 years in business. In every episode, Judy interviews professionals who help others successfully manage their financial lives. You can find this show on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, Stitcher, and more. Judy is the author of 2 books, How to Be Smart, Successful, and Organized with Your Money for a Better Today and Tomorrow, and her latest book, Mastering Your Financial Life Cycles, How to Successfully Manage Money in Every Decade of Life. You can read chapters of her books and catch prior episodes of the show at www.judithheft.com. Now, here's the host of Mastering Your Financial Life, Judy Heft.
Hello, everybody. Welcome. Welcome to episode 63 of Mastering Your Financial Life. And today I'm really thrilled to be here with Katherine Taylor. Katherine calls herself the lawyer for business owners. She's a business lawyer. And not only is she a lawyer in private practice, she's also a CPA, which brings a really different head to the table. So she's got that financial piece and the legal piece. So she's really a great lawyer for business people. Anybody thinking about starting a business, anybody that already has a business, they've been in business for a while, partnership situations, whatever that means, she can handle it. She's also a professor at University of Maryland School of Law, teaching intellectual property and entrepreneurship. So today, welcome, Katherine. I'm really happy to have you here as my guest.
Thank you. Thank you very much.
My pleasure. So today, there's so many different things. I think, a lot of people think, I'm just going to start a business. Why do I have to do? What do I need a lawyer for? What do I have to, have any paper? So what are some of the first things that, a business owner should do to ensure that their business can operate effectively if they become incapacitated or they might pass away or, a number of things can happen? And what should they really do to protect themselves?
So the first thing that any person running a business should do is make sure that they have formed an entity. That's usually an LLC. Many times it could also be a corporation, because that entity is a separate legal being from the person who owns it or from the people who own it. And so when a person becomes incapacitated or passes away, that entity can live on so long as you've put the right documents in place so that that entity can live on. If you've already formed an LLC or a corporation, then what you need to do and make sure that you always do is keep that entity in good standing. And what that means is, you file the annual reports with whatever state agency requires reports to be filed, that you properly register in states in which you're doing business, that you pay your taxes, not just income taxes, but state unemployment taxes, workers' comp. Many times the failure to pay taxes, either sales tax, property tax, excise tax, etc., to the state, can result in the forfeiture or the nulling and voiding of the company's charter. So all those things need to be in place if you've already formed a corporation or an LLC.
Oh, so that's really great. I didn't know that. So what's the difference between becoming a solo practitioner, forming an LLC, or deciding to become a corporation? There's 3 different things there. And I think most people don't know the difference. It took me a while to figure that out too. I don't understand it.
So many people, if somebody just decides to start a business, they can certainly do that, without registering an entity. If I go out, or if you go out and decide you're going to start, selling gift baskets from your basement, you can do that without forming an entity. In that situation, you would be considered a sole proprietor. You would be running a sole proprietorship. The important thing to remember is that because you haven't registered an entity, which is a separate legal person, the business is you. You're the business. If, however, you register an entity, say either an LLC or a corporation, it's the entity that does business with those customers and clients and vendors. It's not legally, it's not the person that does that business. I mean, if you have a closely held or a very small business where there are only one or two owners, by all means, the owners are going to be facilitating the business, but it's important to remember that it's the business entity that is entering into contracts, that is hosting the website, etc. And when you do that, the important thing is this: if there is a claim against the business entity, so I'll give you an example. Let's go back to the baskets in your basement. Let's say somebody sells a gift basket that has soaps in it, and somebody buys a basket and has a really bad allergic reaction, and there wasn't proper notification of the ingredients, and they sue the business. They could potentially sue the entity, and let's say that LLC has $50,000 in the bank account of the LLC, maybe has $1,000 worth of inventory and some computers, etc. If there's a judgment rendered against that business, then it's only the assets of that entity, the money in the bank account, the computers, let's say, that could be attached to satisfy that judgment. However, if that entity is not in good standing, or if there is no entity in the first place, then the creditor can basically go after the owner's personal assets. So, if the entity itself is only worth, let's say, $60,000, and there's a $100,000 judgment, that owner's assets could be on the hook if there is no entity, or if the entity is not in good standing. And that is why it's so important to make sure that the entity remains in good standing with the state all the time.
So that means renewing licenses and renewing things. So
exactly.
And so what should someone do? They probably think, well, I don't want to pay a lawyer. I know a lot of people say that, which is foolish. We tell everybody, no, hire professionals. Sure. But what happens if they decide to do that? Now, how do you register this entity? You have to fill out the articles of organization and pick officers.
Correct. So we actually tell people who come to us to form LLCs that they don't have to hire us to do it. You can go to the state of whichever state the entity is going to be registered in. We practice in Maryland, so the registrations we do are primarily in Maryland. But if you're in Delaware, New York, New Jersey, you would go to that state's Secretary of State, Corporation Department, whatever it's called. And most states allow you to actually register that entity online, and it's really not that difficult. However, what we tell people, and people do hire us a lot, it's easy, but it's really easy to me and our staff, because we've done it a gazillion times. But it's not that easy. I mean, there are questions that are asked that you don't necessarily know the answer to. What resident agent should I use? Who can act as a resident agent? What's the principal office? What does that mean? So there's if we answer those questions for our clients. Also, what's even just as important as registering the entity is those things you do after that entity is actually approved by the state. You must get a federal employer ID number. You should always open a separate bank account for that entity. There might be state registrations that are required. And for an LLC, you should have an operating agreement for the LLC. We draft operating agreements for our clients. And an operating agreement is, for an LLC, kind of what the bylaws are for a corporation. It sets forth the relationship among the members of the LLC, the members of the owners. It sets forth how the revenue and profits and losses and distributions will be allocated to the members. And most importantly, for the people who might be listening here who are interested in the financial aspects of running the business, in an operating agreement, you can actually set forth what happens to the business or to the person's interest in that business if they should die, become incapacitated, go into bankruptcy. get divorced. You can set forth all of those things in an operating agreement. And if you do that, then that person's interest, which is an asset, may not have to go into the person's estate and be probated. So, so again, you can certainly do it yourself, form the entity, but taking all those steps after the entity is formed is really just as important as forming the entity in the first place, especially if you have an entity that's owned by more than one person. It's absolutely necessary to have that underlying agreement that basically discusses what happens to the business if one or the owners should, like I said, something should happen, or they want out, or like I said, they go into bankruptcy.
So what happens if they don't have that in their operating agreement or the articles of organization, and they have it in their will that, I'm a partner in this business, and if something happens to me, my part of the business goes to, my heirs. Is that good enough, or does it have to be in the operating agreement? How does that all work?
It's better than nothing, but here's the thing. So the operating agreement in many states is allowed to kind of act as a will for the business. So if in the operating agreement there is a clear indication as to what happens to that ownership interest, let's say if somebody passes away, then that interest, which is an asset of the owner, doesn't go into the person's estate. It goes wherever the operating agreement tells it to go. And so that interest then doesn't have to be probated.
So it saves taxes?
Not necessarily saves taxes, but it definitely saves a lot of time and headache. Now, it could save, whether or not something goes into an estate or not doesn't necessarily affect taxes, but it certainly could affect the cost of the estate administration, the time of the estate to be finally administered can be months sometimes, and that could basically cause the business to kind of be in a paralyzed state for a while, because if, let's say, if it's a sole owner who doesn't have the proper agreement and that sole owner passes away, the LLC interest goes into the estate, and the personal representative of that estate basically is running the business now. So, and that's not necessarily a good situation.
Right. That's not always the right person, I'm sure.
Correct.
Now, if you know how to run the business.
Absolutely. And this becomes so much more important when you have more than one owner. Because nobody really goes into business expecting to be in business with a person's spouse or their kids if the kids are the beneficiaries. And so that's why it's so very important to make sure that these things are taken care of before something happens. I'll give you a really quick example. I have a client who's been a client, was a client of ours in kind of a matter unrelated to the underlying aspects of the business. He called me a couple of months ago to ask if I could represent him, or the business actually, in the sale of the business's assets to a third party. And we said, yes, we can certainly do that. And we had him, on behalf of the entity, it was a corporation, sign a legal services agreement hiring us. 2 days later, he passed away. It was a shock. And so fortunately, he, on behalf of the business, had already hired us to represent the business. And remember what I said, the business kind of stays alive. So we were representing the business and doing what it needed to do to get the business affairs in order as a result of the sole owner having passed away. He didn't have a will, which was not good. So this stock did go into his estate. It had to be probated, which basically means the the personal representative had to do some things to, basically act as the owner, but we were able to kind of get through that. But that is an example of how, had he put the right documents in place, well, had a will and had documents relating to the business that stated what would happen should he pass away, we wouldn't have had to go through all of those steps that we went through. It would have been much more seamless.
Yeah, you know what? I'm always surprised to this day that people don't have wills, especially a business person. How can you not have a will when you own a business? I mean, it's just, I know it's people are afraid to face death, and I think that's one of the reasons why they don't have wills. They don't know who to have their, executor. They don't know who, if they have children, they don't know who to have the guardians of their children, so they procrastinate it. But it's such a mistake.
Yeah, well, so it is, and my sense is that when you're with your clients, you probably advise them very strongly to make sure that they have the proper estate planning in place. And I'll go back to this situation. He did not have a will, and his wife survived him, but because he didn't have a will, half of his assets went to his wife and the other half went to his kids, which was okay because she was okay. She had enough, but in a situation where there could have been an estrangement with the kids, or maybe she wouldn't have had enough to live off of. That is usually not what spouses intend. They usually believe that all their assets go to the other spouse should they die, but the laws of intestacy in a lot of states are state otherwise.
Yeah, that's pretty interesting stuff too to talk about. I could really get
that's a whole nother.
Exactly. Yeah. Let's take a little break now, and then I want to come back and talk about bank accounts and commingling funds, because that's a sticky situation, I think.
Hey there. I just want to tell you a little bit about my new book that just came out called Mastering Your Financial Life Cycles. And here it is. It's how to successfully manage your money in every decade of life. I co-authored this with my CFO, Liz Levy. And together we created this manual that's going to help you through every stage of life. We talk about having a baby. We talk about young adulthood, pre-retirement, what to do when you're at that age of retirement. If you're contemplating divorce, do you need an estate plan? We cover all of these, each subject in a different chapter. And I really think that you're going to find this so helpful, because at the end of every chapter, we have checklists that you can look at and you can use, and they can be a guide for you. So this is a wonderful manual that we've created. It's available on Amazon. You can also find it on our website at judithheft.com/book. And we're here for you. If you need anything, reach out. I hope you enjoy the book. Here's another picture of it, just so you know what's going on. Here it is. And I'm really proud of it. It's my second book, and I'd love to have you read it and give me your feedback. Judy Heft, judithheft.com, financial and lifestyle concierge, celebrating 26 years in business. And over the years, I've learned so much. And what I've been trying to do is impart a little bit of this knowledge to you, so I can help all of you become as financially organized as I am.
Hello, everybody. We're back. We're back to Mastering Your Financial Life with Katherine Taylor. So, Katherine, one of the things you said earlier that kind of jiggled something in my brain was, commingling funds, not having a business checking account. And that drives me crazy. And I see a lot of that with some of our clients when we take on new business clients, and they have everything. It's just a complete mess because it's all jingled in there together. So, I think one of the questions here is, how should your business bank accounts be titled? And who should be the signatory? And do you need two signatures? Is one enough? These are all things to think about. And what's your take on that, Katherine?
So the business bank account should always be titled in the full legal name of the entity. So if it's the name of the entity that I own is Katherine L. Taylor, PA. Even though we use a trade name, Katherine Taylor Legal, the bank accounts and all the contracts that that entity enters into are in that full legal name. Secondly, you should always have a separate bank account. Now, if you're a sole proprietor, there isn't that legal distinction between the person and the entity. But it's still really important for accounting purposes and even tax purposes to have that separate bank account, because expenses that you incur on behalf of the business are deductible, but personal expenses may not be deductible. And so, even from an IRS or tax standpoint, it's necessary to have that separate account. If you don't have a separate account, and if you commingle funds, that is a clear factor that would be looked at if any creditor is trying to get to the owner's personal assets. So once you form an entity, like I said, you have that separation of liability and that limitation of liability. But if you don't do those things necessary to keep those two entities or persons who exist separate, then you can lose that liability protection. And as I said before, then a creditor could then go after the assets of the person and not just of the entity.
Yeah, that's really.
Yeah, and in terms of signatories, so it's always a good idea to have at least one additional signatory other than, let's say, the owner of the business, for practical reasons and for legal reasons. For practical reasons, let's say the person goes out of town, or somebody needs to write a check, then they could do that. And for legal reasons, if the owner is the only signatory, let's say on that account, and that person dies, then I'm going to go back to the situation that I discussed before. Then the personal representative of the estate has to go to the bank and provide all of the corporate documents showing that somebody who is in the role of an officer of the corporation has been authorized to name a signatory on an account. It basically takes a long time for that process to kind of be put in place. You typically would need to contact a lawyer to draft those corporate documents just to allow somebody else to be approved to be a signatory. And so if you've already got that in place, somebody's already named as a signatory on a bank account, then that just eases the load of the person kind of cleaning things up if somebody should die or become incapacitated. Now, of course, you would want to make sure that the person is trusted. And a lot of banks don't even require that it be an officer of, let's say, of the corporation or an owner of the business. It could be, a spouse, let's say, who would have to be directed on behalf of the business, but at least you've got somebody with access to the bank account.
Yeah, so that's what I was going to ask you. If it's a solo practitioner, even if it's an LLC, a solo practitioner can also, or a solo owner, I guess you don't call it a practitioner, can also be the owner of the corporation as well. And so who is the best person to pick for that? Do you want to pick your spouse, or, maybe it's your next in command, your operations person in your company? How do you know who's the right person to pick for that? That's a sticky situation, I think. Then you're giving access to your finances to someone that's not your spouse or another officer of the corporation.
Right. And just from an accounting standpoint, this is where the CPA stuff comes. So you want to make sure you have a separation of duties. So if you have, let's say I would name my practice manager as a signatory on the account, she's not able to reconcile the account. She's not the one who reconciles the accounts. I have a separate bookkeeper who reconciles the accounts. And so if the practice manager would decide, she's going to basically embezzle, some funds from the account, then that would be found. It doesn't, by the bookkeeper who reconciles the accounts each month. So it's always a good idea just in a business to make sure you have a separation of duties. And even when you're a sole owner, you can do that by having, if you're doing everything as a sole owner, you don't need the separation of duties. But if you have someone, let's say, working with you who writes checks, then you want to make sure that not that person, that a different person, either you as the owner or, a different person with a different role, reconciles that account. It's really tough to decide who to name as a signatory. I think a lot of it just comes down to trust. But even if you trust the person, you have to make sure that there are safeguards in place, because even the most trusted people can, get into bad situations and decide to take somebody else's money. A spouse is always a good idea if you don't have anybody else. But the problem with that is many times the spouse doesn't have anything to do with the business, doesn't know what's going on, and so may not be the best person to kind of look at the business as a whole and say, oh, what do we need to do with this business?
But it's good to have that trusted person as a backup, just in case.
Correct.
Even if they can't run the business for you, at least they're there
on the bank account. Exactly.
Yeah. Something happens. That's great information.
Right.
So this was really helpful and informative. So how can our listeners find you?
You can go to our website, taylorlegal.com, or we also have a YouTube channel. The link will be below. And I have filmed a lot of videos, just very short, quick legal tip videos for business owners that many have found really helpful. They're really short, so you don't get bored reviewing them. And then also, very recently, I filmed a video on what is called the Corporate Transparency Act, which was a federal law passed a couple of years ago that will affect virtually every single small business in this country. I suggest that you go to my YouTube channel and review that video. There will be a download if you do view that video on what the Corporate Transparency Act is.
Well, thank you, Katherine. That's really helpful. And I'm sure they can find you on LinkedIn.
Yes,
want to put
absolutely.
your email out there? I don't know if you want to give your email, but that's always helpful too.
Absolutely.
Great. Thank you so much. Thanks for being
All
a great
right.
guest.
Thank you.
Thank you for tuning into Mastering Your Financial Life, hosted by Judy Heft. You can read chapters of her books and catch prior episodes of the show at www.judithheft.com. Thank you for your positive comments and sharing this show with others.